Stock market gains have continued since Donald Trump was announced as the 47th president of the United States. The S&P 500 is up 2.6%. You have stocks like Tesla up over 14% since the news, and just in the past 2 days, my portfolios have gone up $20,000 in value. So the market is clearly reacting well to the news, and the US is poised for 4 more years of lower corporate taxes and deregulation. And as we all know, growth in earnings per share will lead to increased capital return to shareholders via dividends and share repurchases, and ultimately should drive up a company's stock price over the long term. A president's policies can have very real impacts on the world and the economy, and it certainly seems like right now the stock market is reacting as though it does. However, there are some stocks going down. And in today's video, I'm going to share 5 stocks that have the potential to go down and be negatively impacted from a Trump presidency. This is a follow-up to the video I just made, which has gotten a good response, going over my top 5 stocks that would benefit from a Trump presidency. But as always, guys, I want to reiterate that you should not let politics impact your investing strategy. As an individual, you have the most control over your own economic well-being. You have to be hyper-focused on increasing your skill set, your earning power, your income, and then intelligently investing that money to grow in the future. A president is not going to do that for you. You still have to do it. And when it comes to stock analysis, the same principles still apply. A great business is a great business regardless of who's in office. And a bad business is still a bad business. Even some companies which may benefit from Trump's policies, you don't want to own. They are not good investments. Likewise, you don't want to own bad companies that are reliant on government support. As always, guys, I'm going to try to keep the politics out of this and keep it focused on the stock analysis and business. But that said, I will cover some issues that may impact stocks. So don't shoot the messenger and don't get crazy in the comments. That said, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. And if you want to use the stock analysis tool I use throughout the video, then sign up at dividenddata.com. We just launched our new AI chat feature, Ask Dividend Data. This allows you to ask any investment question and get a response from an AI-powered investment research analyst, summarizing the latest quarters and earnings, and finding new investment opportunities with a stock screener using hundreds of financial metrics. And to celebrate the launch of this AI tool, we're doing a 50% off sale of dividenddata.com. You can lock in that price for life. Sign up with the link in the pinned comment and description, or create an account directly on our web app and use the promo code AI, that's the 2 letters AI, at checkout to get 50% off for life. There's a 30-day money-back guarantee, so no risk in trying it out. Stock number 1 to avoid during a Trump presidency would be Rivian Automotive, ticker symbol RIVN. And this really includes any unprofitable electric vehicle maker, which is every single one aside from Tesla. Other examples I would stay away from include Lucid and NIO. Rivian stock was down nearly 10% after the presidential election results, and the reason is that Rivian is losing a massive amount of money on every vehicle they sell, and they are unlikely to reach profitability in the next few years. And politically speaking, the main reason for this stance is that Trump does not want an electric vehicle mandate and will take steps to make sure that does not happen. And also, he wants to remove the EV tax credit. So this will increase the cost of EVs for consumers. But what that really means is that we have a fair playing field. And in a fair playing field, the bad businesses will lose. And the stock market has already realized over the past few years that Rivian is a risky and bad investment opportunity. They are losing massive amounts of money every single quarter because they lose money on every single car they sell. And yes, they had a massive amount of funding from Amazon, so that does give it a little more protection than other electric vehicle companies. And they did have a very strong balance sheet, with back in Q4 2021 having $18.13 billion in cash on hand. However, when you have over negative $1 billion of free cash flow every single quarter, that cash position will start to dwindle, as it's now down to $7.8 billion. And during that time, they have also grown their debt from $1.5 billion to $5.8 billion. And unless Rivian can come out with a lower cost, profitable vehicle, this company is on a fast track towards possible bankruptcy or a forced acquisition to another larger company like Amazon. Rivian is not a sustainable business, and there is a lot of execution risk on whether or not they can get there. And this is not saying their cars are bad. They actually are like really well designed. They look pretty cool. But Rivian is in an incredibly hard position. They are basically where Tesla was in 2016 or 2017. And it's a very different world. It took an insane amount of effort and frankly probably luck for Tesla to successfully launch their low-cost vehicles and become highly profitable. Now Tesla is more profitable than even the legacy gas automakers. And that's just the electric car part of Tesla's business. They are a much broader technology company than Rivian. I would stay far away from companies like Rivian, and I would even stay away from legacy automakers that stand to benefit from Trump's policies. For example, you have his tariff policy to prevent foreign cars from entering the US, a proposed lower 15% tax rate for companies that make their products in the United States, and he's even played around with the idea of allowing individuals to deduct interest on their car payments off their taxes. And all of these things would help the automotive industry. But Ford, General Motors, and these companies are bad investments. And just because the president's policies may help keep them around and improve their financial situation, they will still be bad investments. These companies do not grow, they're highly capital intensive, and are facing a massive innovator's dilemma as they make all of their money on their gas cars, and their electric cars are losing massive amounts of money. So they're facing this problem trying to switch between a profitable vehicle and an unprofitable vehicle. So I would not want to touch any of these companies in the automotive sector outside of Tesla. Stock number 2 is NextEra Energy, ticker symbol NEE. NEE stock was down 6% after the presidential election results. And really this category more broadly would be any green energy company that benefits massively from tax credits. And I'm going to provide some stocks that I would say are outright sells, but I would not put NEE in that category. But you should be aware of some of the changes that are coming. Historically, NEE has been a fantastic stock. Earnings per share have grown at a reliable rate for a number of years. This is even a dividend growth machine with a 11% 10-year compound annual growth rate of the dividend and a 2.77% dividend yield. So it has that combination of good dividend yield with high dividend growth. However, this is a company that has definitely followed the government money train, and that has led to great results. The 10-year total return for NEE stock is 264.5%. That's from stock price appreciation and dividend reinvestment. And to be fair, this is a very diversified company. They operate in wind, solar, nuclear, coal, and natural gas, but they have shifted their focus towards renewable energy generation and battery storage projects. And they have benefited from a lot of provisions in the Inflation Reduction Act, which was really a clean energy bill, and that still has trillions of dollars allocated, not yet spent. And one of the things Trump was running on was reallocating a lot of this money towards broader infrastructure projects, not clean energy projects. For example, I mentioned the EV tax credits. There's also charging infrastructure grants, but specifically for NEE, there's a production tax credit, which is for wind and other renewable energy projects. That's for the first 10 years of operation. An investment tax credit for solar and other renewable projects, a clean energy production credit, a clean electricity investment credit, and you really could go on and on here. And this is trillions of dollars of incentives moving around in the market. And a lot of this is now subject to change. So I would not invest in any company reliant on these government programs. And although NextEra Energy may benefit from them, I would not say they're necessarily reliant on them. The companies I would actually stay away from are things like Plug Power, ticker symbol PLUG. This company loses a shit ton of money, and the stock market really has not had tolerance for these kind of things over the past few years, ever since we got out of the COVID bubble. So the stock price already has been punished significantly. And I asked Dividend Data to find me some more renewable energy stock examples, and here are some including Vista, Brookfield Renewable Energy Corporation, the AES Corporation, Clearway Energy, NextEra Energy Partners, Sunnova Energy International. So you'd have to dive in and do the research yourself, but this is just some things to be aware of as you're investing. And remember, each company has its own financial position and specific things going on. And now we're getting into a little bit more controversial territory. As many of you know, RFK Jr. will be leading the health departments for the Trump administration, and there will likely be massive reorganization and safety standards across the FDA, CDC, and other health agencies. So there will be a lot of pressure on Big Pharma across the board, and at a minimum, there's a lot of uncertainty. Things that have been discussed include banning pharmaceutical advertising on television, possibly removing liability protections on vaccine manufacturers, and removing mandates so that it's a choice, not banning vaccines, but making it a choice and doing increased health studies. And this isn't an industry I follow very much, so I was going through the vaccine manufacturers list, and I came up with two stocks that seem to have a large number of vaccines. That's GSK and Merck. Also, Sanofi US. Now, the good thing is a lot of these are bad investments, so you probably shouldn't be considering them for your portfolio anyways. They make a lot of money, but they do not grow. And growth is a vital part of long-term investing. So for GSK, you can see that their stock price has remained flat for a number of years, and that's because earnings per share over the decades has been completely flat. But GSK, for example, makes 52% of their money from the United States, and they make $9.5 billion a year in vaccine revenue. I don't know if any of these would be the ones affected. I am not an expert in this. But if we look at Sanofi, again, it's a bad investment. There is no growth here at all. And of the stocks I mentioned, Merck is actually the best one. It has seen pretty good stock price appreciation over the past decade and increase in earnings per share. And this actually is a dividend growth stock with the 5-year compound annual growth rate of the dividend at 7.97% and a 3% starting dividend yield. And it's important to mention that these are very diversified businesses. So it very much is speculation at this point about how they could be impacted. And then, of course, you have Pfizer, which is his number one beef since the pandemic. So I really have no idea what could happen. But what I do know is many of these stocks, in my opinion, are bad investments. They have financial characteristics I would have stayed away from anyways. So with this increased risk, I would continue to stay away. GSK stock was down 3.3% after Trump won. Pfizer stock was down 2.8% after. Merck stock was flat. And also interestingly, Novo Nordisk was down as much as 6% following the news. And this is one of the companies leading the weight loss drug effort. I believe their brand is Wegovy, not Ozempic, but it's the same GLP-1 product. And RFK Jr. has campaigned publicly that he does not want these products to be in Medicare and Medicaid or any government preferential treatment. He has far different ideas for how to combat the obesity crisis. I personally already don't invest in the pharmaceutical space, and I definitely do not have any more interest in it at the moment, given the increased uncertainty. And then for stock number 4, I have Lockheed Martin, ticker symbol LMT. And this is not one I would put in the outright sell category, but there's an interesting topic we can discuss here. And this is a stock which actually went up 3% following the news. However, I would be cautious on most government and defense contractors right now. And the reason is for a couple of things. First off, we're going to have this new government efficiency group, which is aiming to cut $2 trillion out of the federal budget. And even if they hit $500 billion or $1 trillion, then that's still going to be a lot of money. But I also think we're going to get a lot of evolution in how government contracts are done in the defense industry. For example, you have startups like Palmer Luckey's company Anduril, and they do a completely different pricing model compared to the traditional military industrial complex. Instead of a cost plus model where you're kind of incentivized to inflate your costs in order to grow over time, Anduril just makes products and services and sells them, kind of like how real business works. So I think we're in a shifting environment where there's going to be a lot more competition for government contracts in the future. But I don't think defense spending is going to go down because Trump actually is very pro-military spending, you know, peace through strength and all that jazz. But Lockheed Martin is trading close to its all-time high, and that's while having barely grown over the past few years. And despite the Ukraine war, which is likely going to end soon, and conflicts in the Middle East, which will probably come to a close soon as well. So there's just some uncertainty around this. But that said, I actually picked probably one of the best examples of stocks you would invest in the military industrial complex. Lockheed Martin has been a good performer over the long term. They have seen long-term earnings and stock price appreciation. It is a dividend growth stock. The 10-year compound annual growth rate of the dividend is 8.2%. It's a very sustainable payout ratio of 45% based on earnings per share and 49% based on free cash flow. And with a current 2.4% dividend yield, it's a very attractive dividend growth stock. They even buy back shares consistently. So of stocks in this sector, you should buy Lockheed Martin. But I personally am staying away from this. And I would stay way more away from companies like Boeing. They are in a massive amount of trouble. And given they've actually had bad business performance and many public failures, I imagine Boeing would be the first target in losing out on some government contracts. So I would stay away from that. And back on the health side of things, with RFK Jr. being involved, there's increased risk in processed food companies. And you're seeing this sell off across the board. For example, Coca-Cola sold off 3.4% following the Trump win. PepsiCo followed suit, selling off 2.5%. You have Kraft Heinz selling off 1.5% in the following days, which is less significant. You have General Mills selling off 4.8% following the news. And in general, these companies are likely to face increased disruption to their current product portfolio in the market. And that's because there's a lot of chemicals in their processed food products that are likely to be banned by the FDA. Now, I don't think this is a long-term risk for any of these companies, and actually it may help them over the long term, because I don't think it's in their interest or the public interest to have harmful chemicals in food. But that said, I would not sell the Coca-Cola company or PepsiCo because of these reasons. Again, we should go back to my fundamental principle at the beginning of the video. A good business is a good business, and a bad business is a bad business. Politics only impacts so much. Coca-Cola and PepsiCo still own the best brands in beverage and snacks. So all that will happen is they may have to change the ingredients in some of their foods. And I actually think Coca-Cola and PepsiCo may benefit from some of the policies in the Trump administration. For example, lower energy costs will flow throughout the entire economy. That will lower transportation costs as they ship products across the United States, and costs might come down across the board in their bottling facilities. Plus, a lot of these products are made and manufactured in the US, so they may benefit from a potential lower corporate tax rate for companies who make their product in America. At a minimum, they'll benefit from corporate taxes just not increasing. But as I mentioned, a bad investment is still a bad investment. You have companies like Kraft Heinz, which would face many of the same processed food problems, but this is a stock where the earnings per share is slowly declining. Likewise, the stock price has remained flat for a number of years. This is a stock you would want to avoid regardless of who won the presidency. So those are some stocks to avoid, or at a minimum may be negatively impacted during a Trump administration. You also have other risks I did not discuss, like potential tariffs, but those have so much uncertainty I really couldn't even predict how they may impact an individual company. And there are also many US stocks that could benefit from such policies. But anyway, let's not get too political, and remember that we have far more control over our own financial situation than anything the government does. We have to continue to make smart choices, invest in ourselves, increase our skills, grow our careers, and then intelligently invest your money to grow in the future. We have to do this regardless of who's in office. But that said, if you enjoyed the video, please leave a like and subscribe to the channel. Sign up for dividenddata.com and ask our AI investment analyst a question. We're currently doing a 50% off sale to celebrate the launch of our AI tool. So sign up now so you can lock in that discount for life. Link in the description and pinned comment. Thanks for watching.